Hello, my name is Dr. Paul Cottrell. I am recording this on 8/16/2026 before the markets open up in Asia. I'm going to go over some of the chart updates for the different asset classes and my perspective on some of the geopolitical problems that are happening. We are also going to go over the AI bubble. But before we do, please help support the work that I do by going to my website, the-studio-reykjavik.com, and get the great products that I offer. I also have classes that you can sign up for, and you can donate. You can donate through Stripe, Buy Me a Coffee, and PayPal. It's a great way to help support the work that I do. All these videos are for free. You can also watch my audio archive, listen to my audio archives, or watch my live stream shows under broadcast radio or broadcast live, respectively. In terms of the store, you can get ebooks on finance, genomics, artificial intelligence, endocrinology. You can also sign up for my classes on pulmonology and immunology. Each of the modules costs $25. You get a lot of videos and a lot of PDFs. For example, under the pulmonology, you get all these subject matters, different videos, different PDFs. You can learn at your own pace. You get a unique password. You sign up for the class, you get that unique password, and just go to classes and then type in the password. It's really easy. And I also have supplements. So let's go over some of the supplements that I have on my store, and then we're going to go over the updates on the financial markets. Structural nanosilver toothpaste will whiten your teeth, freshen your breath, reduce inflammation, improve your gum line health, and neutralize because it's a structural nanosilver. It has no fluoride. Max 35 or Cleanse are great to boost up that innate immune system. Take a teaspoon a day, swish it in your mouth, gargle about 20 seconds, and then swallow it. It helps to neutralize and protect that oral pharynx. Structural nanosilver gels that I have, you can get the tube form or the quick dispenser form called Renew. The structural nanosilver gels can be used as a daily topical, heal a wound quicker, and you can put it on your hands and lightly coat your nostrils during the allergy seasons and the cold season. Lozenges, I have the structural nanosilver lozenges that are in Manuka honey and in orange splash. They're perfect for the cold season and the allergy season, and when you're just cleaning around the house. And they're made from structural nanosilver. They'll help to neutralize. I have probiotics that will help to improve your gut biome. That's really important to bring down inflammation and improve your digestion. Your metabolism will improve, even your skin health. C60 is a very potent antioxidant. You can get in a 2-ounce, a 4-ounce, or an 8-ounce configuration. It is cheaper to get the higher ounce configuration because the cost per ounce is less. So you get a little bit of savings, and if you buy a 4 or an 8-ounce, you can also use discount 5 to save additional. Now, extra virgin olive oil, you can get it in avocado oil and MCT coconut oil. Now, C60, you take a teaspoon a day every day. And with that, this is going to soak up those free radicals, help with your brain function, your cardiovascular health, your immune system, your endocrine system. They'll help to slow down the aging process within the tissues and the cells, improve the health of the mitochondria, and your energy levels will improve. It's a very important antioxidant supplement. Vitamin D3 is a gene expression cofactor, also helps with bone density and cardiovascular health and boosts up that immune system. Vitamin C and magnesium helps with brain function, skin health, and brain function. Omega-3 helps with cardiovascular health. This will bring down inflammation and help control your lipid profile. Ashwagandha root controls your cortisol levels and your blood glucose levels. Goodnight formula has tryptophan, melatonin, GABA, and passion flower, so you can get into 3 to 5 cycles of REM sleep and deep sleep, so you're consolidating memory and detoxifying your body. A probiotic, this version of the probiotic is in the powder form, and you get all the benefits that you get with the other probiotic too. The other probiotic is the VeggieCap version. Resveratrol. Resveratrol will soak up free radicals. It also helps with youthful gene expression and helps to get rid of cells that are in senescence. So it helps slow down the aging process. Take resveratrol. It's really a great supplement to take with C60 to improve the basal layer of your skin. Vitamin B complex, the first 4 B vitamins, helps with the electron transport chain. So you produce more ATP, you have more energy, your cellular metabolism will improve, and you are protecting your neurons with vitamin B12. Turmeric can bring down inflammation and soak up those free radicals. Magnesium and zinc helps with brain function and boosts up that immune system. Lignans helps with the immune system and the endocrine system, helps with bringing down inflammation and soaking up free radicals. Collagen will help your skin health, nails and hair, musculature, bone density, and your joints. Digestive enzyme complex helps you to break up carbohydrates, proteins, and lipids to reduce the load on your pancreas. Clarity factor is a very powerful neurostat that will help you to concentrate and over time improve cognition and memory. Olive leaf extract helps to bring down inflammation and control your lipid profile. So this is going to help with cardiovascular health and the immune system. Zeolite will bind to heavy metals, toxin chemicals, allows you to urinate them out within 6 to 8 hours. Take 3 small drops underneath your tongue and drink filtered water. Do that daily. Myotrol will help to build muscle. Myotrol has polyphenols, flavonoids, and lignans to help with the gene expression to build muscle. Boomer Boost has 68 nutrients. You can use this as your multivitamin. It has the multivitamins and the minerals that you need daily. It also has a plethora of additional supplements within this compound. This is a month supply. And Boomer Boost will help with the cardiovascular health, help with the musculature, help with cellular regeneration, help with brain function, slow down the aging process, and boost up those energy levels. This is a product that you should be taking every day. So get the Boomer Boost. Gladiator barley and heirloom barley. They both detoxify your body, bring down inflammation, soak up free radicals. So that's very important for your immune system, your endocrine system, brain function, cardiovascular system. Gladiator barley has one added benefit, and that will help to build muscle. So do some resistance training to build that muscle and take the Gladiator barley. Gladiator barley and heirloom barley stack very well with Boomer Boost, and the Gladiator barley stacks really well with the Myotrol. Collagen is a great supplement to take to help to remodel your arthritic joints. It will block MMP3 and MMP13 to reduce joint erosion. It blocks EP4 that reduces inflammation. It helps to use collagen type 2 and ACAN. And collagen 2 will help to remodel the cartilage. ACAN helps to remodel the cushioning. Collagen also helps to recruit glucosamine, which will help to rebuild the cartilage, and chondroitin utilization to help do the cushioning of the joint. And collagen also helps to block the pain channel gatekeeper NAV 1.7. So it's a great supplement to take to remodel the joint. And super strong relief. Super strong relief will help tension headaches, muscle pain, pain from a bruise, a sprain, and also arthritis. It's a topical. You apply it and on the area of pain, and within about 90 seconds, the pain is relieved. I also have ubiquinol, which is the the most bioavailable form of CoQ10. It'll soak up free radicals and help with energy levels. NAD plus will help to repair DNA, and NAD plus boosts up ATP levels, boosts up your energy levels. And nattokinase will help with your cardiovascular health. It'll help to control LDL levels and break up clots. And I have a lot of anti-aging boxes and longevity boxes that are available, such as the advanced anti-aging box, which has Max 35, your choice of C60, vitamin D3, vitamin C and magnesium, toothpaste, and the Digest probiotic. So this is a great way to start your journey, and they're at a lower price point. You can buy these products separately, or you can buy them in this curated fashion. And it's a great way to start your journey and slow down the aging process. So with that, please go to my store, the-studio-reykjavik.com, and get the great products that I offer. Now we're going to go over the charts. Okay, the first chart is the SPY, which is the ETF for the S&P 500. Again, for the ones that don't know, I've been saying that the S&P 500 target, year-end target is 7,800 to 8,000. So that equates for the ETF SPY to approximately 780 to 800. And you can see in the price action here, we had that gap up earlier last week. Was it last week? I'd say Friday, Tuesday. 1, 2, 3, 4, 5. So we had that gap up 2 weeks ago. So, or beginning of August, I should say, the gap up. And normally when you have a gap up, there's a big run upward. If you have a gap down, normally there's a like right here, gap down, it tested and then failed and started falling. But normally you have a gap up. Now here you had a gap up and then it dropped back down. You had another gap up and then drop back down. But some of this is due to I think it was the tariff policy that was coming back into the news back earlier, late last year. But the bottom line here is that when you see a gap up, it starts to trend. We do have a resistance level at 780, and it's testing it. It's trying to get break. It's probably going to break it, and we'll have another resistance level at 800. Now, the support levels are 720, and this fib sequence of the 23% retracement at about 708. So you can round that to about 700. So you have a strong support level at 720 and another support level at around 700. But 708.79 is the technical support level based on the fib sequence. Now, what I did was I put about 7% in cash that was invested in the broad indexed, and I'm waiting for a drop off, especially if we start hearing problems with AI investment before I redeploy that 7% cash. Now, CL is the future for WTI for oil. The dynamic has been pretty much what I've been saying for a while here. If you have good news out of the Strait of Hormuz, it's going to be trending in the 68 to 79, 62 range. If you have negative news happening in the Strait, it's going to trade above 79.62 and trend between 79.62 and 87.23. We had as high as almost 85, around $85 a barrel. It trended down the last three sessions a little bit, and it's trading at 82.40. If we don't hear better news coming out of the Middle East, I suspect that we are going to be trending in this tight range between 81 and 85. But it could be as high as 87.23. I suspect that we will not be doing kinetic events because we are having issues with the Abraham Lincoln. There seems to be some supplying issues for the aircraft carrier. It's getting relieved by the aircraft carrier George Washington. My understanding is that it takes 18 days to get into the region. I don't know what day started the traverse across the Atlantic for the George Washington aircraft carrier. So I suspect this month we probably will not have kinetic activity. The question is, will we have more oil flowing out of the region through tankers, or will we still have a constrained situation? If we have a constrained situation, it's going to stay in this range and start to creep closer and closer to the 87.23 mark. The problem that we have here is that the higher the oil prices are and the supplies start to diminish in the derivatives, for the downstream products like gasoline and diesel and jet fuel and fertilizer. When those supplies around the world start to diminish, we're going to start seeing commodity prices, especially for energy and for agriculture, start to climb. That's going to be a pulse for inflation. That's going to be a major problem for the world economy, on top of we're spending down our strategic reserves of these downstream products and of oil. So our shock absorber to absorb the actual shock of the war in the Middle East is starting to weaken. And we're going to start feeling the full pain of the war effort if something positive doesn't come to fruition within the next few weeks. Now, it looks like that Trump is losing capacity to continue the war. It makes Trump look weak. It looks as if Iran has somewhat control of the straits because the United States can't really get back to pre-war movement of oil, and we probably will continue to see problems in the economy. But if we get something positive that is sustaining, we'll start seeing $68 a barrel oil. But the probability of it getting back down to that level is diminishing. Trump's looking weak, and now there's talk that maybe he won't do anything until after the midterms. Well, that's in November. So that means that we are diminishing our shock absorber, and we are now baking in more inflation in the economy. And so yield curves might go up. It's a major problem. Now, natural gas, I have a small short, I have a small long position in natural gas, and I'm going to most likely on Monday put a large short position on natural gas. I also have a short position small short position in oil at the moment, very small. Now, the natural gas situation, normally in August, it starts to sell down. Now, here's a chart. The price, I have two curves here. I have the candlestick, which is the natural gas, and then cold, which is an ETF to short natural gas. So that's inversely related. The price on the left for the y-axis is for the ETF cold, and the candlestick price is on the right. So right now, natural gas is trading at 2.715. That's the future market. And cold is trading at 30.53. So because it is August and we have El Nino and we have AI and what's going on in the war in the Middle East, but it seems to be somewhat stable. The question is, will natural gas go up or down? It should historically go down. But because of these variables that I've said, what could drive the actual price of natural gas? So let's just walk this through logically. Right? So there's these few variables that can affect the price of natural gas. Now let's assume that there was no war. There's no AI development using more energy in certain areas of the country. Typically, we should see a fall in the price. And in the summer, that was what has been happening. It's been falling down. But there's these periods of time where it kind of pops back up, and these candles right here coincide with some of the concern about what's going on in the Middle East. It seems to be correlated. You can see those. It's similar to the price action that was going on with oil. Now, it should go down because of just normal dynamics of the summer. It should go down to about 2.5. Now, yes, we have El Nino. It's a hotter summer, so more people are using their air conditioning, so it could be a little bit more elevated compared to last year. So we're right at about where last year was. But last year in June and July, it was higher than what we had before. So we should see, this is the reason why I think that we should be dropping below what last year was. But it is a hotter summer, so more people are using energy, and natural gas is part of the energy grid. So that may be part of the reason. You have AI using natural gas in some regions to serve the calculation, the power of the calculation farms. But some of these generators are running on diesel too, so it's not completely natural gas related. I suspect that we should see a drawdown, we should see a price moving closer to 2.5 in the near term before it starts to creep up. Now, normally when you switch over to September, then it starts to creep up and it kind of comes down. But it's weather related, it's also supply related. So I think that there's a little bit of a potentiality of natural gas going to 2.6. I think fair value is 2.5 before it starts to creep back up, but it's because of the war and because of the hotter summer, it's probably not going to hit it. But 2.715, we might actually see a 2.6 or 2.65 before it starts going back up. When it starts to go back up, I wouldn't be surprised that we're talking about 3.1, 3.2. So I'm going to put a large short position in on Monday and then probably start slowly accumulating a long position in natural gas. going into the fall season. Now, TYD is a ETF that helps to leverage, though, track the belly of the curve, the 7 to 10 year treasury market. So if the candlestick price goes up, that means that the the bonds for the 7 to 10 year price are going up and the yields are going down. Now you can see that there's been an overall trend drifting down, down, down. Now part of that is that's a leveraged ETF and that there's volatility decay. But if you look at just the last few months, last 4 months or so, it's been trending down. And this is because yields are trending up. Now I'm going to show you this in another chart. So the candlestick price is the ETF for TYD. The line chart is showing the relationship between the S&P 500, and it's inversely related, typically, but it does undulate. But textbook bonds should go up in price when the stocks go down, and when stocks go up, price for bonds should go down. That's textbook understanding. But there's an undulation. And this year, there's been a higher correlation to the stock market than let's say last year. You can see that there was actually more of a negative correlation last year, but it's a much more positive correlation this year. So as stocks move up, there is a tendency for this ETF to also go up, that bonds could go up. Now, let's think about this for a sec. If they're worried about the Federal Reserve to raising rates, stocks are going to go down. If the Federal Reserve is going to raise rates, that means that the yield curve may be shifting upward, and that's going to affect the belly of the curve. And that also makes sense that there would be a positive correlation. Now, if the Federal Reserve lowers rates, what's going to happen? It should help to push down the yield curve. So yields are less, so bond prices are higher, and people will invest more in the stock market. So right now, in the epoch that we're in, you don't get the normal diversification when you're doing the bond market. And there's this trend of getting back to a yield curve that is pre-Lehman, the yield curve, pre-2008 yield curve. So we're going to see higher 2 year yield, 10-year yield, 20-year yield, 30-year yield over time. So that would mean that there's more probability of TYD going down than up. So let's take a look at some of the dynamics here. So we have a support level of 2236, and we have a resistance level. There's two resistance levels here that are developing. Through the fib sequence, there's a very strong resistance level at 2341, and we have a resistance level of 23. So the trading range right now is going to be approximately about 2250 to about 23 at this moment in time, with a strong support at 2236 and a very strong resistance level at 2341, with a trading range at around 22.5 to about 23. Okay, so but there's this pressure of yields going up. Now, if the Federal Reserve makes their move, at least in the short term, and lowers rates, we probably will see the yields on the 7 to 10 to go down, at least in the short term, and the price of the 7 to 10 year bonds to go up. So that will also fuel this positive correlation where bond prices will go up with the stock when the Fed lowers rates, at least in the short term. In the long term, most likely people will start be concerned with inflation because when you're lowering rates, you're actually pumping more money into the system, but that would be a little bit, that would be probably a lag effect. So if the Federal Reserve lowers rates, we should see TYD go up in price. The stock market should go up. And if they did lower rates, I wouldn't be surprised that we would be testing that 2341. And then you would have a new support level of 23 instead of a resistance level. But it all depends on what the Federal Reserve does. Now, if they raise rates, what's going to happen is that the yields are going to go up, the price is going to go down for the bond market for the 7 to 10. And so we're going to be testing the 2236. So it's heavily predicated on what the Federal Reserve is going to do. Okay, this chart goes a little bit more deeper in what I've been saying. This line right here is the federal funds rate. It's at approximately the effective federal funds rate is in a range, but this is printing at 3.63. Now I have three curves above that. You have the 2-year, the 10-year, and the 30-year yield. The 2-year yield is trading at 4.15. The 10-year is trading at 4.63, and the 30-year is trending at 5.21. You can see since the beginning of the year, it's been moving upward. The yield curve is going up. Now, if we go back to TYD, which is the price of the 7 to 10-year bonds, going all the way back to the beginning of the year, it was trending down. It's trending down. So the price of bonds are trending down, the yields are trending up. So we're moving towards a new era where we have higher interest rates. So TYD should be continually to go down and test the 2236 mark unless the Federal Reserve starts to do a series of rate cuts. But they have problems with inflation. This goes back to the oil problem and the tariff problem and what's going on in the Middle East. So I have a feeling that the Federal Reserve may need to be raising rates. And if that's the case, then we're going to see the 10-year yield hitting closer to, right now it's at 4.63. It's going to go to 4.8. And by the end of the year, we may see close to 5, or first quarter near the end of first quarter of next year, 5 for the 10-year. And that would mean that we're looking at 5.5, maybe even 5.7 for the 30-year. Now, for the 2-year, I wouldn't be surprised that we hit above 4.4 at that same time period. So inflation is a problem. And will the Federal Reserve do something about it? If they do, they're going to affect the yield curve and also the stock price. And this is the reason why I was saying have about 7 to 10% in cash, because if the Federal Reserve starts to increase the rate to try to fight inflation, you're probably going to see a sell-off, right? You're going to probably see a sell-off, some kind of dynamic like this. The Federal Reserve lowers rates, there's going to be a sell-off, and then it's going to try to creep back up to the high point and then kind of retest it and just kind of trade in a consolidation pattern and then start marching back up. That's kind of the thinking that I have. That's most likely what's going to happen if the Federal Reserve if the Federal Reserve raises rates. If they lower rates, it's going to gap up bigger than this and then start marching up. It's going to be if the Federal Reserve lowers rates, it's going to be very bullish for the stock. But if they lower rates, they're probably feeding into the inflation and the AI bubble. Then that's the reason why I'm going to be playing this video about the AI bubble. Another possibility is that if the Federal Reserve lowers, or if the Federal Reserve raises rates, instead of it coming down and then consolidating and then coming back up, it may trade more like this, where it sells off hard and then comes back with a vengeance because of people having cash on hand hitting these support levels. Remember what the support levels are. 720, you got 708, and you got a very strong one at 665. So if there is a big sell-off, there are these key points where people are going to put money in and drive the market back up. So this is the reason why you want that 7 to 10% in cash to wait it out. You should keep, about 95, 90% of your position in the broad index and just, no matter what happens, don't do anything. But that cash that's on hand, just wait until that big move from the Fed. And or the bubble of AI, whichever comes first. But I think that there's a higher chance that the Federal Reserve raises rates than lowers rates. And that would mean that there's should be a decline of at least 10% in the S&P 500. And then you redeploy the cash, and then you'll be able, as it's marching back up, you'll be able to benefit from it. So that's kind of the thesis that I have here. All right. Now, this also ties in, we have low volatility through the VIX index. And normally there's these spikes that happen. Like right here, these lines here are a month. And normally it's around like a 2 month time period on average where there's, a decent level of spike. So you had a good size spike here. This would be, so we had, about a month, almost 2 months here. So this happened second week of June, and this spike here happened just before August. So you had July, you had June and July. So you got about 2 months here where it was spike to spike. Now, there's this low VIX level of 14. That's pretty low. Normally it's higher. So we should start seeing us creeping back up to about 16. And when that, at the end of the month, would be a little bit more than a month in a new cycle of stress in the VIX, a new volatility spike. So it's starting to look like we probably won't see a bigger spike like this one or this one until somewhere at the beginning of September, maybe the first or second week of September. We should start seeing more stress. And that will get you to about, a month and a half from peak to peak. So I suspect that there's probably, I was thinking at the end of this month, but I don't think we'll get above 20 by the end of this month. I think it's going to be second week of September. And that would mean that for this month, the S&P 500 should keep on creeping upward. So we should be surpassing 780 for SPY and creep to about 790, maybe even test 800 by the end of the month. And when it fails that test, I suspect that's when you start seeing the VIX start to spike. Now I have two other charts here. One is shorting the semiconductor industry. Now this is going back to the idea, the thesis that there's an AI bubble and it's going to affect the semiconductor industry and it's going to affect the tech industry. So SSG shorts the semiconductors. Now, right now, short term, it's been trending down because investors are moving back into tech and into semiconductors and into the AI trade. Before this trend down, it was moving upward. And in July, the sell-off in tech in the Mag 7 and some of the AI plays, people were selling out, and that because this is a short for semiconductors, it started to trend up. So you had a decent like 12, maybe 12 and a half, and it went as high as about 16. And then it started to trend down as people were, especially in August, there was move back into tech and the AI trade started to play out again. Now let's coincide that with what's going on with the S&P 500. Same thing's happening here. The gap up in August and then it's trending up. This is an AI play. This is an AI play. So when the AI bubble does burst or starts to deflate again, we're going to see dynamics like this, maybe even more violent. But there's a little bit more room for it to trend up, is the point. So this short for the semiconductor industry should now test 10. It should test that 1091, which was the low for this time period. It's now at 1137, and you probably have a trading range between 1125 to about 1225. But as long as there are positive news coming out with funding for NVIDIA and Anthropic and the talk about Anthropic's IPO, this is probably going to trend down and test the 10. Now, this ETF, USD, is the long for the semiconductors. It's the inverse of SSG. So if the semiconductor industry is moving upward in price, then this ETF goes up. And you can see that there's this interesting fib sequence that has been developed. So we had the start of this fib sequence is around the end of March, and there was a big movement up all the way to the beginning of June. And then there was starting to be at the beginning of June, there was a sell-off in tech and the semiconductors. There was a little bit of a relief rally, and then it came back down. But there was an overall trend down. Now the question is, are we developing a channel here? Are we developing this channel where we're at the top of it and it's starting to come down? If that is the case, then SSG is going to pop up to about 14. If this fails, now here's the interesting part to this. If the market keeps on going up and everybody's positive about AI, the market is going to rally, SSG is going to go down, and USD is going to go up. Now, as the semiconductors were selling off in the beginning of June and through July, it started to had that big gap up. You notice that big gap up in August. So this is all that AI trade. It tested and failed, but came back up. It tested that 61.8 retracement level. So from the low in this time series, or not in this time series, in for this year, I should say. I took the low for this year. And the high for this year, it's very close. These support levels are very close. It did break, but it was close to the 38% retracement. And then when it failed, when it tried to get back up to the high and it failed, it broke, but it also came close to the 61.8% retracement. And what's interesting is you can see that some of these relief rallies that failed, almost touched the 50%. And then when it did another relief rally and failed, it was somewhat supported again by the 50% and came back up, failed, broke the 50 and tested the 61. So we were having a tighter channel. Now the question is maybe there's a larger channel that's being developed between this point and this point here versus this point and this point. But this gap up may prove to be it moving upward and break the 100. So in essence, I think that it's close. It's not perfect, but I think that this fib sequence, based on just the price movement, the low to high in this year, is somewhat indicative of trying to model and predicting where the support levels are. It's a little bit off, but I think it's close. Now, in August, the beginning of August, we did have this movement up and broke that 38% retracement resistance level. And now is in a trading range between the 88.18 to 98.9. So let's just round it to, you have 88 as a support and you have a resistance at approximately 99, almost 100 for this ETF, USD. So if there's positive news in the Fed with the semiconductors and the AI trade, the USD is most likely going to break 98.9 and start getting back above the 100 range. All right. If we have negative, then what's going to be, we're going to be testing the 88 support level and maybe break it. But right now there's this trading range in 88 to 98, 99. I think in terms of the movement in the S&P 500 and the debt issuance support for NVIDIA by Goldman Sachs and BlackRock, I suspect that this year there's some more money on the sidelines to invest into these AI stocks. So if you are bullish about the semiconductors in the next few weeks, USD may be a great ETF for you. If you're negative on the on the semiconductors, I think that you may just want to wait. You may want to wait and have this ride up a little bit more, and then maybe try to short it by using SSG. I think SSG is probably going to be testing the 10. The probability of it testing the 10 price level compared to going to the 15, the probability going to 10 is higher. The probability of USD going to 100 is much higher than it testing 88. So that's the overall market and what I think is going to be happening. I do think, though, that in the fundamental aspects of the AI bubble, that there's too much of a build out. There's too much debt. There's too much circular financing. AI and Anthropic don't have viable business models, and there's a problem here. But that doesn't mean that there's not money out there to pump the bubble up a little bit more before it bursts. And this is the reason why I'm concerned that the S&P 500 seems to me that it's a little bit, because of the AI issue, it's a little bit too bubbly. But it's going to test the 800. It's going to test the 800 before this burst. So with that, let's listen into a video I want to share. And this video is going to be what Ed Zitron has to say about the AI bubble.
The AI trade is getting another vote of confidence from Wall Street. JP Morgan says big tech's massive AI investments are starting to pay off, while Nvidia is turning to private equity and credit giants like Apollo and Blackstone to help fund the next phase of the build-out. But as big tech takes on more debt to keep up with the AI spending race, questions are growing over whether the returns will justify the cost. Now, to help break it all down, I'm joined by tech industry analyst Ed Zitron. Ed, thanks so much for coming back on.
Thanks for having me.
So I want to start on this headline coming out of JP Morgan. Wall Street for years has been asking, when will we finally see AI CapEx spend pay off? And now we're seeing JP Morgan is raising its S&P 500 target, saying that it's seeing evidence of those returns. Do you think that they're declaring victory too early?
I think they're declaring victory when they should be declaring failure. Right now, analysts and actually Bloomberg reported as well that 70% of AI revenues are from OpenAI and Anthropic, two companies that can't afford to actually pay for the compute. And that's across Microsoft, Google, and Amazon. Their future revenues are based on their ability to harvest money from two companies that can quite literally not afford to pay them. On top of that, their actual compute spend is going to be $100 billion or something this year. That may sound like a lot, but already big tech has spent over $1 trillion in CapEx. They're going to spend another $1 trillion next year. Trillions more if they're allowed to have their way. I'm not sure how the mathematics works here. Microsoft's AI revenue for fiscal year 2026 was $34.33 billion. Of that, OpenAI represented $24.1 billion. Even with OpenAI's money, that's pretty pathetic considering they've spent $261 billion in CapEx since 2022. I don't know what JP Morgan is talking about, but I will say stock values are not a representation of reality. And as we've seen with the AI bubble, because the media and the markets have been giving credit to big tech for AI paying off, despite the fact that AI really hasn't, and it definitely hasn't even put a dent in the amount of CapEx they're spending.
And so with the stock returns, obviously situational awareness, that hedge fund imploded. They had a huge bet on AI. Do you think that that is a sign of the AI bubble, or was it just a hedge fund taking on too big of a risk?
I think we're going to have a few more of those. I think we've got Bugavara as well. We've got more to come, I think, with those. Because what those are is, it's funny. On top of being very risky, it attempted to apply a logical-ish thesis to an illogical market and an irrational market. I mean, Leopold Aschenbrenner I think he's married to someone who works at Anthropic. He clearly has an MPI. Also, he has $2.5 billion, maybe $5 billion worth of Anthropic stock in situational awareness. But his bet was that semiconductor stocks would just run infinitely. Of course, that wasn't going to happen. Nothing runs infinitely. Even things that go up seemingly forever have down periods. And he was clearly over-leveraged. The problem is that increasingly retail investors are over-leveraged too. So at some point, these violent shakes that are going to start happening, that are going to start washing people out, they're not going to be hedge fund sized people, but retail investors are going to face the same kind of things because right now, the stock market, the US stock market, actually, a lot of stock markets are effectively casinos. They're not based on whether the companies are good. They're based on some wobbly version of news combined with vibes, combined with reading the tea leaves of companies, especially in the case of the AI companies that have really only ever lost money.
Since 23 years old, I've gone to 4 to 10 business conferences every year. It doesn't matter if it's a family conference, generational wealth conference, investment conference, where to invest your money, or raising your family, or even a revival church conference. I wanted to put a business conference together where we can talk money, business, family, faith, politics, and nobody walks on eggshells. And that's exactly what we did with the Vault.
And going back to that hedge fund, last year it had about 200% in returns. Do you think that we could continue to see the AI trade work, even if you think these businesses won't?
I think for the AI trade to grow much further, The businesses have to show stuff that they're not right now. I think that these tech stocks connected to AI can keep running because the market is completely insane. CoreWeave, their losses are increasing with their revenues. Their debt is increasing with their revenues. No one seems to care about that. They don't care that CoreWeave has $40 billion worth of debt. What they care about is number go up. The thing about that is that can run very far, right up until the vibe cracks, right up until the market stops having confidence in this irrational thesis. Who knows what that could be? Maybe it could be OpenAI not IPOing. Maybe it could be Anthropic's S1 being, I don't know, looking like the inside of a funeral home. Maybe it could be something else. Maybe it could be a surprising event from one of the AI companies. Maybe CoreWeave not being able to raise debt. Either way, we are in a vibes-based casino market. And so anything could happen. Things could keep going up no matter how bad things get. But at some point, reality will dawn. And at some point, the money will run out.
And you think that could be when Anthropic or OpenAI IPOs? I
think that Anthropic's S1, I think they're going to try and do some dodgy stuff with capital expenditures. I think they're going to try and put their training costs as CapEx. If they do that, welcome back to 2001. Welcome back to the dot-com bubble. I also think that if their economics are rotten enough, it could really shake people. I also think that there's just a wall that's going to be hit with these neoclouds like Nebius and CoreWeave. CoreWeave, when they last raised debt, they had to pay over 9%. That is an insanely large amount, and they're not done raising debt. They're going to need tens of billions of dollars more to fulfill the contracts they've already signed. So at some point, they won't be able to raise debt. At some point, there are limits to the amount of debts a company can raise. And I think CoreWeave will be one of the companies to hit them. I also just think that the AI data center boom is fueled by debt. So it really is just a question of when credit markets start rejecting this stuff. And I think that's going to start happening in the next few months.
But there's a lot of smart money going into this data center boom right now, right? We saw NVIDIA partner with these huge names and put $500 billion up. And now Bank of America is pledging up to $250 billion as well. Why do you think the smart money is sort of rotating into it if you think it could be such a bubble?
Well, a few things. One, I don't think the money's smart. Two, that $500 billion deal doesn't exist. It's a memorandum of understanding between NVIDIA and multiple different asset managers without any formal explanation or vehicle or anything as to how that money will actually be delivered. So I think that deal, just starting with that, is going to end up being a few smaller deals and then nothing else happens. Again, nothing has actually been signed. There is no partnership. Bank of America has done stupid stuff before. Every bank's done stupid stuff before. $250 billion vaguely in infrastructure, it's really easy to just not do. Who's going to check? How would they check? And I think the smart money is no longer I would not apply that to this market. I would apply it. This is a manipulated market. It is a market that is disconnected from business fundamentals, driven mad by AI. And so I think this NVIDIA deal is, if anything, a sign that things are very brittle. Because if NVIDIA had diverse demand, and just to be clear, analyst expectations have NVIDIA making over $1.6 trillion in the next 3 years. This is a company that's desperate. This is a company that knows they can only hit those expectations by creating, I don't know, the monolith, the ultimate form of circular financing, where they create a theoretical, really theoretical, they haven't done anything yet, pool of capital that builds data centers that get rented out to AI companies that can't afford them, and NVIDIA will backstop. But again, still theoretical. NVIDIA has not signed anything. It's an MOU. And the last time NVIDIA did a big MOU was when it said it would invest $100 billion in OpenAI and build 10 gigawatts of data centers, neither of which happened.
But couldn't we see Wall Street partner with NVIDIA and these big names? Couldn't this continue for years? I mean, what do you think could really be the catalyst to end all of it?
So with that deal, it's all asset managers. It's the Apollos, the Brookfields in the world. They're already in data centers. So people are treating this like, oh, this is private credit's first touching. God, no. Blackstone, BlackRock, Macquarie. I don't think Macquarie's invested in this one, but they're all over the data centers. They've been in the data centers for years. Blackstone was early in CoreWeave. BlackRock got in there eventually as well. They're already in. So this is just doing more of the same. So $500 billion is a great deal of money. I think it's going to be tens of billions of dollars if they do that. But again, data centers take 18 to 36 months to build. So it's not like this is going to happen quickly. On top of that, they will still have to raise the funds from somewhere, from limited partners, from, I don't know, sophisticated individual investors. And there are limits to the amount of capital. There is this mythology of, oh, there's trillions of dollars on the sidelines. Not with interest rates going the way they are, not with inflation the way it is. And so I think the NVIDIA's point of that announcement was not actually to sell GPUs, it was to create the illusion that they would sell $500 billion worth of them, which is very typical for Jensen Huang. He is as much a marketer as he is a CEO.
The reason that your scissors do this instead of cutting through the plastic is not.
And you mentioned circular financing. I want to stay on that really quick because NVIDIA's CEO has largely dismissed concerns around it. If the demand isn't there yet, what's wrong with big tech subsidizing the build-out until it is?
Because they're spending trillions of dollars for an industry with tens of billions of dollars of revenue, most of which comes from two companies that big tech also has to fund. There's, in reality, outside of OpenAI and Anthropic, including AI software, there are single-digit billions of dollars of revenue. Unless they're planning to fund this for 1,000 years, they're not going to make trillions of dollars out of this. Microsoft's what, a $320 billion a year in revenue company? How are they going to actually get this money back? They're not. The answer is they're not. Wall Street, even though they're crazy right now, I don't think Wall Street has unlimited patience. And the big problem that all of these companies have is that their future growth, all of their consensus estimates from analysts, are based on Anthropic and OpenAI. For example, Stephen Ju from UBS had a note at the end of June that said that 48% of 2027 Google Cloud revenues, not AI, all of Google Cloud, are coming from OpenAI and Anthropic, over $124 billion. That will be contingent on whether they can raise the money and whether the capacity exists to use it. And if they fail to raise the money, if they fail to build the capacity, the growth that Wall Street is expecting will not materialize. And in turn, Wall Street will be very angry at these companies that were supposedly growing with AI. So really, in the next year, I hope it's not a year, but in the next year, we're going to see whether the rubber actually meets the road. And they're sinking this, I think that they started sinking this money in 2023 because growth had slowed and they believed it would turn into something different. And it hasn't. And I kind of see what they're doing. I mean, what are they going to do? They're going to go on their earnings call and go like, yeah, all of our growth's coming from two companies that can't afford to pay us. That sucks. No, they're going to tell the best story they can until they're forced to tell another one.
Couldn't you flip that around, though? I mean, $80 billion in annualized revenue from leading AI startups in an industry that barely existed 4 years ago. Doesn't it show extraordinary demand?
It shows that we're in a hype cycle. All the king's horses, all the king's men, everyone has talked about AI nonstop for 3-4 years. It is the only thing AI was half of all venture funding. $178.5 billion of data center deals. Every business idiot, every CEO, AI. $80 billion of annualized run rate, which means month times 12, is not actually as impressive as it sounds, because it's not saying they will make $80 billion of revenue. It's saying that a month-long period multiplied by 12 was this number. And there's a reason they use those numbers. It's to make things look better than they are. Anthropic projected to make $10 billion of revenue in the second quarter of this year. It's a lot smaller than 80, but they want people to talk run rates because it makes them seem bigger. And on top of that, they're subsidizing their customers. On the $200 a month subscription, you can spend $14,000 on OpenAI's ChatGPT and $8,000 on Claude. Yeah, when you're selling $40 for $1, that's going to get you a demand, especially when everyone's screaming that you must use AI.
But on that utility point, once a user gets hooked onto ChatGPT, Claude, or Copilot, and they see that it really does save them time, they're unlikely to go back to their old way of working. Just like when the internet came out, people didn't go back to manually looking through yellow pages. Why is an undeniable user utility sort of a sign that the market will succeed in the long term?
That suggests that utility is there, which isn't. So a lot of software engineers really like this. But again, how much actual productivity do they get out of it? Not really had any good news out for there. There was a study that the Register reported on at the end of last year where people using AI coding tools said they were 19% faster, they were 10% slower. And when it comes to regular tasks, AI is not actually that reliable. It's not got great ROI. It's very hard to measure. On top of that, ChatGPT, Copilot, Claude, they're all kind of the same product at this point outside of brand recognition. And then there's the fact that if it was so incredibly useful, why would the companies be so unprofitable? Why would they be doing this weird circular financing? Why did Amazon, who was meant to give OpenAI another $35 billion when they IPO'd or when they hit AGI, send the money early? And it's because the actual products they're not stable economic vehicles. They are ultimately doomed companies that are being propped up. And the only reason they've got this far is because hyperscalers built all their infrastructure and paid their bills.
And Mark Zuckerberg just laid out pretty much the opposite vision of what you just said. He thinks AI will create a lot of companies, and he thinks it'll be embedded in our everyday lives. But when you look at the economics, you see a bubble. How do you think these realities can be so different?
Well, because Mark Zuckerberg is lying. Mark Zuckerberg wants you to think about superintelligence. He wants you to talk about anything other than the large language models he has. Here are some stories about Mark Zuckerberg's large language model. Reuters reported at the end of last year that an old man talking to a Kylie Jenner branded bot fell to his death because he had dementia. He was led by a Kylie Jenner bot to his death in New York. No one really has any stories about Meta's LLMs because they don't really do very much other than normal chatbot stuff. Mark Zuckerberg is writing 6,500 word screeds because he wants everyone to think about anything else. The difference between me and Mark Zuckerberg is I'm talking about reality.
All right, watch this. Hear that? That's my wallet. So this is what most wallets still look like. Thick, overstuffed.
And I want to stay on big tech. You've mentioned big tech's growing spending debt, but do you think that debt is actually manageable because these companies have huge underlying cash-generating businesses?
I think they're manageable. I don't think Microsoft, Google, and Amazon die. I don't think so, but they are going to, I'm quoting Ed Elson of Prof G Markets here, they're on Botox right now. They are trying to make themselves feel young again and growth vehicles again when they're actually old, boring companies that are aging and exiting the era of hypergrowth. And so I think that they will manage their debt loads, but I think their debt loads are going to destroy their profitability. I also think Meta dies in the next decade. I think Meta's product is decaying. They lowered Q3 guidance. Their ad platform is overbilling people. Their product is a mess full of bots. It's decaying. I'm not saying it's going to be quick, but Meta has made all of these obligations as their business slows. And I don't know what other options Mark Zuckerberg has, but he's failed, categorically failed, to create any other product other than ads.
And when you look at the whole ecosystem within the next year, what part of the AI market do you think falls first?
So I think it has to be data center debt. I think data center debt is the one thing because they're claiming there's, I think, over 300 gigawatts worth of capacity in planning. That's going to require trillions of dollars just for the GPUs and then the construction and all that. I think it's not going to be that AI data center debt stops entirely, but I think it's going to be much harder to get. And this whole machine, from the AI startups to the data centers to the NVIDIA GPUs, is built on this easy and constant flow of capital. If that capital slows, if that credit stops existing, at least not as quickly as they need it to, if CoreWeave can't raise every 3 months, then I think that's what starts scuppering things, because this whole thing demands momentum. And without that momentum, and without the hype, and without the misinformation and disinformation, it can't survive. And I think it will slow and then crash. And the sign will be data center projects getting canceled, as in the ones in planning, the ones under construction, and then one falling apart that's been built. Once that starts happening, we're approaching the end.
And who feels the consequences of that debt? Is it Goldman Sachs, Blackstone, the companies that are partnering with NVIDIA in these big projects?
I think the people that will feel it, it really depends on how bad it gets, but it could be pension funds. It could be the pension funds and insurance funds that are backing the asset managers. It will be the local communities that are left with half-developed data centers just sitting littered with dirt and half-built powered shells. It's going to be the communities that gave them the tax breaks and won't get any of the tax revenue that they're theoretically meant to bring in the future. It's all the people that the promises were made for. And fundamentally, the people who are going to feel it the worst are the retail investors, the ones that were conned into doing this, that were conned into thinking number would go up forever. And I think in the end, in the worst case scenario I can imagine, though, there are real consequences for the pension funds, public pension fund, teachers' pension funds, firemen's pension funds that are piled into private credit funds investing in data centers. I don't know what they're going to do.
And I want to end on this. The last time we spoke, you said the moment to watch was when one of these big tech companies pulls back on their AI capex. We just had another earnings season, and quite the opposite happened, actually. Despite mounting cash burn, Wall Street rewarded hyperscalers that showed accelerating cloud growth. Isn't that evidence that the spending is starting to produce real revenue? Or when do you think that we can start to see some sort of crack in the earnings?
So that comment I made earlier about the 70% of AI revenues for Google, Amazon, and Microsoft coming from OpenAI and Anthropic. Mysteriously, their cloud platforms are growing, just as Anthropic and OpenAI are growing, because as they grow, they spend more money on compute. The cloud growth we are seeing seems like diverse demand. What it actually is two unprofitable, unsustainable companies burning money that is increasingly given to them by the hyperscalers themselves. Amazon sent $50 billion to OpenAI this year alone. That's the thing. Of course, like, I'm handing money to myself and showing it to Wall Street. And because Wall Street and analysts and the media increasingly fail to hold these companies accountable, clap their hands like seals. They said, this is great, I love it. Even though there was no proof, none, that AI was providing this. And one other final thing, Microsoft in Q3 fiscal 26, they disclosed their AI run rate. They said 37 billion. They then stopped disclosing it in Q4. I wonder why. Could it be that it was worse? Who knows? We will never know because they refuse to tell us.
All right, Ed, we'll keep an eye on what next earnings season tells us. Thanks for coming on.
Thanks for having me.
So that's the end of this broadcast. Thank you for watching. Please pay attention to the markets. It's really important. We're moving into tumultuous times, especially with what's going on in the Middle East and this AI bubble. But that doesn't mean that it's going to burst right now. But it does seem as though that bubble that was deflating a little bit in July is now being reinflated in August. Please go to my store, the-studio-reykjavik.com, and help support the work that I do by getting the great products that I offer. And these products are products that I use every day to stay healthy and to slow down the aging process. All these videos are for free. Please help support the work that I do by sharing the links. Ask your social media to follow me. I think the information I'm giving is very valuable. And if you would like to donate, you can donate through Stripe, PayPal, or Buy Me a Coffee at the very bottom of this homepage. So thank you for listening and have a nice day.